99% of the money in the world is debt, not cash, not banknotes, just numbers, created by banks out of nothing. A bank doesn't lend you money. It creates it the moment you sign a loan. And now, I'll show you how this actually works. Let's imagine a simple situation. You walk into a bank and deposit $1,000. In most people's minds, it works the same way. The bank takes your money, puts it in a vault, and keeps it there until you decide to withdraw it. As if somewhere inside the bank, there's a box with your name on it that says, "Do not touch." But that is the core mistake. A bank is not a storage facility for money. It is not designed to protect your deposit. A bank is a business that makes money by issuing loans. The moment you put money into your account, it stops being yours in a literal sense. In reality, you've loaned that money to the bank, and the bank now has the legal right to use it to issue loans to other people. That's why it pays you interest. It's not a reward or customer care. It's the price the bank pays for using your money. And here's the key point. The bank is not required to keep your entire $1,000 in reserve. It can keep only a small portion and release the rest into circulation. So while you're looking at your banking app and seeing your full balance, that money may already be loaned out to someone else, spent, recycled through the system, and working somewhere completely different. And if tomorrow all depositors showed up at the same time to withdraw their money, the bank physically wouldn't be able to give it back. This isn't a glitch. It isn't a crisis. It's the normal operating state of the banking system. That's exactly how it was designed. Fractional reserve banking. How banks actually do it. So, how does a bank decide how much money to keep and how much to release into circulation? This is called fractional reserve banking. It sounds complicated, but in reality, it's extremely simple and extremely cynical. The government or the central bank sets the rule. A bank is only required to hold a minimum reserve. For example, 10%. Everything else it's free to use. You deposit $1,000 into the bank. Under this system, the bank keeps $100 as a reserve and is allowed to issue $900 as a loan. And here's the crucial point. The bank does not hand out that $900 from a vault. It simply creates it on the borrower's account. The money appears in the system at the moment the loan is issued. No one printed it. No one saved it for years. It comes into existence as a digital entry in a computer. And once that $900 exists, it starts moving. The borrower spends it, the seller deposits it into a bank, and the cycle repeats. The next bank keeps 10% and lends out the rest again. This is how the same original $1,000 triggers a chain reaction in which the total amount of money in the system multiplies many times over. And this is why banks aren't afraid of running out of money. They don't operate with existing money. They operate with permission to create new money. The money multiplier, how nothing turns into a lot. Let's look at what happens next and why the system appears stable, even though it's actually built on air. You deposit $1,000 into a bank. The bank keeps $100 and lends out $900. The person who receives that $900 spends it, buying a product, a service, or an asset. The person who receives that money then deposits it back into a bank. To the bank, this is now a new deposit, even though in reality it's the same money. The process repeats. The bank keeps 10% and lends out the rest. Those funds return to the system as deposits again, over and over. As a result, from the original $1,000, the banking system can generate up to $10,000 in total money. This isn't a theory, it's an official mechanism known as the money multiplier. But there's a trap almost no one talks about. All of this new money exists only as long as the debt exists. If new loans stop being issued, money disappears. If loans are repaid on a large scale, the amount of money in the system shrinks. That's why any slowdown in lending triggers crises, recessions, and panic. Because when debt disappears, money disappears with it. The system cannot remain stable. without constant credit expansion. This isn't a flaw, it's the foundation. Interest. Why debt can never be fully repaid. Now we reach the most dangerous part of the system, the part almost never explained honestly. A bank creates only the principal of a loan. It does not create the money needed to pay the interest. If a bank issues a $1,000 loan with interest, exactly $1,000 enters the system, no more. But the borrower is required to repay, for example, $100. The question is simple. Where do the extra $100 come from? They do not exist at the moment the loan is issued. They can only appear if someone else takes out a new loan. In other words, for one borrower to repay debt with interest, another borrower must go into debt. And this process never ends. That is why the entire system depends on constant credit expansion. When new loans stop being issued, interest becomes unpayable, debts default, and failures cascade through the system. This doesn't happen because people suddenly become irresponsible. It happens because the system is structured in a way where there is never enough money for everyone to repay their debts at the same time. Someone must always lose. And to keep the system running, total debt must keep growing. This is why economies fear not inflation, but the halt of credit itself. The central bank, who actually controls the money. At this point, it's important to understand that commercial banks don't operate on their own. Above them stands the central bank, the institution that sets the rules of the game. The central bank decides how much credit exists in the economy and what that credit will cost. It doesn't print money directly for everyday people. It controls the system through interest rates, reserve requirements, and banks' access to liquidity. When the central bank lowers rates, borrowing becomes cheaper, banks issue more loans, total debt in the system increases, and with that debt comes more money. This creates the illusion of growth, wealth, and stability. When rates are raised, loans become expensive, new borrowing dries up, existing debts become heavier, and money begins to disappear from the economy. That's when crises, bankruptcies, and unemployment appear. These are not random cycles and not bad luck. They are the direct result of someone turning the money tap on or off. The central bank doesn't create wealth. It controls the speed at which the system expands or destroys debt. And every one of those decisions has real consequences for ordinary people. Who wins and who pays? In this system, there are always winners, and there are always people who pay the bill. Banks win because they create money in the form of credit and collect interest on something that didn't exist before the contract was signed. Those who receive the new money first also win. Large corporations, financial institutions, and asset owners. They buy real estate, stocks, and businesses before the new money spreads through the economy and loses value. Everyone else pays. People with fixed incomes, workers, and those who keep their savings in cash or bank deposits. Because when the amount of money in the system increases, prices rise and purchasing power falls. This is called inflation. But in reality, it's a hidden tax. You didn't vote for it, but you pay it every day. And the later you receive new money, the less it's worth. That's why most people feel like they're working more, but living worse, even while the economy is supposedly growing. The system is designed so that wealth flows upward, while risk and losses are pushed downward. And as long as money is created as debt, this won't change. Now look at the system as a whole. Money doesn't come from labor. It doesn't come from value. And it doesn't come from the economy itself. It comes from debt. As long as people keep borrowing, money exists. When debt shrinks, money disappears. That's why inflation is inevitable. Crises are recurring, and savings without assets always lose. This isn't a malfunction, and it isn't a conspiracy. It's the mathematical logic of the system. And the most important thing is this. Most people will never understand why the rules work this way. But those who do stop playing by outdated assumptions. Because in a world where money is created as debt, knowledge is the only real form of protection. That's all for today. If you enjoyed the video, make sure to like it and subscribe to the channel so you don't miss future episodes. See you next time.